One of the most common pushbacks that I get about whole life insurance here on YouTube is from people that follow Dave Ramsey, because Dave is always saying whole life insurance is trash. In fact, I think he says it's the worst financial product in the world. So if you need insurance, you gotta buy term and invest the difference. And term insurance is a much cheaper form of life insurance. And so what I'm gonna do in this video is I'm actually gonna show you how term insurance is more expensive than whole life insurance. Can't wait to show you. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180. In this video, we're talking about whole life insurance versus term insurance. Which one is more expensive? And it's gonna be a really fun video. What I've done is behind me here on my monitor, and I'll share it in a second, I've gone through and I've gotten an illustration for whole life insurance, and then I've got an illustration for term insurance. And I wanted to kind of create an apples to apples comparison about the costs of each one. Now, obviously, this is not gonna be applicable to everybody, and that's gonna make complete sense in a couple minutes. But what I'm trying to do here is to help educate people to see things from a little bit of a different perspective, because at the end of the day, here's my belief, and before I get into this, I think it's important for you to understand this. I'm a big believer that everybody needs to save for emergency, everybody needs to save for opportunity, and we should all have our families protected. Fair enough? And that's where the insurance, the term insurance conversation would come in, or life insurance in general. A lot of people think that I hate term insurance. I actually love term insurance. I have term insurance for myself. I think every single person in this world probably should supplement and have more coverage of a term insurance above and beyond their whole life insurance, because for most people, the amount of money that you can put into a whole life policy probably is not enough actual life insurance coverage to cover what you want to happen should anything tragic happen to you. You want to make sure your wife, your kids, your husband, your family, any charitable organizations, that all that is taken care of when if anything tragic happens to you. And that's the idea here. But in this video, I'm going to do apples to apples, whole life insurance to term insurance, and we're going to break it down. We're going to look at the good, the bad, the ugly, kind of where some of the risks are, some of the challenges, and some of that. And I think whether you think whole life insurance is a garbage product and term is the best, or vice versa, or maybe you're like me and you love them both and it's just a use case thing, I think this video is gonna help give you a lot of clarity on all that. So without further ado, let's go. Let's get into these two policies and have a little bit of fun, because that's what we do here. We have fun with life insurance. So here we go. So what do I have here? I'm gonna get my right color pen going on here so I can highlight. Actually, I'll highlight. So what do we have here? On the left here, I guess I'll zoom out for a second. I have a whole life insurance policy, and on the right, I have a term insurance policy. So now what I wanted to do is I wanted to draw a couple examples. So I want to show this first. I'm going to show the term life insurance policy first. You can see what I have here is a $200,000 death benefit. The initial annual premium is $458. This is a 20-year term. You can see right here, it goes for 20 years. 20-year level term insurance. So what this is doing for $200,000 of convertible term, that's the other thing I want to say. This is completely convertible. Now there are cheaper insurances that you can buy, and that is, I think I want to be totally transparent about that. This $458 a year, we could probably get for $250 a year, something of that, maybe $300 a year, but it would not be convertible at that price. For $458, what does convertible insurance mean? That means if any point in time you, let's say 11 years in, you get this when you're 41 years old, and at 51 years old, you are diagnosed. Well, I'm going to use this example. I have my best friend died at 51, just coincidentally. I wasn't even thinking about that, but when I saw that number, it made me think about it. He died when he was 51. He had a heart infection, totally last minute. He went in for an operation, and he died. But imagine at 51, you're diagnosed with cancer. You know, you get a cancer diagnosis. And when you get a cancer diagnosis, you don't know how long you're going to live, right? You maybe live, obviously, if it's 4 or 5 years, you know, obviously you have this term coverage that will go through year 20, so you're covered. But let's just say at 58, you are diagnosed with cancer, right? Which is obviously the older we get, the more likely something like that is to happen. Well, now all of a sudden, you got 2 years of window here before your term expires. And if you die in this window, you'll obviously get the coverage. But if you die here and you don't survive, well, then this coverage, you either have to make this bigger premium payment to keep the policy in force, or you're going to be without coverage, right? And so obviously you have to look at that moving forward. And the longer you live, the more expensive these premiums get. Here, if you want to keep them in force, the level term premium is only for the first 20 years. Now, here's the one thing I want to say. If you look at this, I want to focus on the first 10 years of this policy, because I think that's going to be the numbers. I'm going to clear all this out here real quick. This is going to be the period of time that's going to be really relevant for our conversation, because I think it's very, very important to kind of, when you understand what I'm about to show you, I think, and I hope, my hope is that it will educate you a way to change your perspective, to think about this in a little bit of a different term, right? So you could see here what we have is we have the cumulative premium. You got $458 a year. That's $4,580 of total premium paid to get you this $200K of level death benefit, okay? So this $200,000 costs you $4,580. It is what it is. So the question is, why would I want to pay more money for a whole life insurance policy when I could just pay the $458? Dave Ramsey says, go and buy term and invest the difference. Take that and invest the difference. Well, this is where I like to counter this. And this is now a whole life insurance policy. Now, what we can see here is that the premium is much, much bigger. We're talking $10,000. $10,000 a year. You can see the cumulative premium after 10 years is $100,000, which is crazy, right? But here's what you'll also see, is that the death benefit keeps going up. And by year 10, we actually have much more death benefit than we had in the level term policy, because that death benefit is going to go up. This is a blended policy of whole life insurance with a term rider to allow us to put more cash value in. Now, Dave Ramsey would say, take the $458 off this. 10,000 minus 458 is what? It's like $9,542, okay? So if we look at $9,542, Dave Ramsey would say, well, take that $9,542 and put it somewhere else, right? I would argue that you don't want to invest this money. You want to save this money, because Dave Ramsey would also say that you need an emergency fund, right? The emergency fund. So the question is, where are you going to keep that? You can keep it in a bank account. It's got to be liquid. It's got to be accessible. You can't have any risk with it. So where are you going to keep it? You're going to keep it in a bank account. That bank account's not going to get a great return. And the question is, what's it going to do for you long term? The other thing here is when we look at this and we look at the fact that inflation is happening, year one here, you're going to have 200,000. It's not really the same value. The purchasing power is not the same 10 years from now in 200,000 as it will be right now, right? So this helps you counter inflation, which is a good thing on the death benefit side. But then on the cash value side, we're talking about comparing this not to an investment, because it doesn't have the same risks as an investment. You have to compare it to a bank account. And so when we look at this $9,542, we're looking at putting this extra, because that's what we're talking about, that extra goes into a whole life policy, and that cash value then becomes liquid. And this is where it gets really fun, because now you can see the net cash value right here, right out of the gate. Yeah, you're a little bit behind. You have to deal with a little bit of a liquidity crunch out of the gate. So the first year you're going to put 10,000 and you're only going to have liquidity of $7,370. But here's the deal, 106,000 by the year 10. So if you look at the net cost, this is where I always, listen, you can't say whole life is cheaper than term. It's a bit of a marketing phrase, and I'm going to be totally transparent. It's a little clickbaity, I get it, but I do believe this principle to be fundamentally true, because if you think about cash flow, well, cash flow on this policy right here is $4,580. And by the time we hit year 20, $9,160, and you only have $200,000 of coverage. So you're $9,160 in, and most people at this point in time, because the premiums start going out of control for $200,000 of insurance, Most people are going to cancel this at that point in time and get a new level premium if they need it and go from there. Now, a lot of people would say, Dave Ramsey would say, well, when you turn 60, you don't need life insurance anymore. You don't need it anymore. So self-insure, do the best you can with your money before that. You're not going to need it. I'm going to show you now why not only do you need it, but you're going to want it at that point in time. So as we look at this going forward here, you could see that we have 106K, 106,766 of cash value. We're, instead of being $4,580 of lost costs, we're actually $6,766 here ahead of our total premiums that we paid. And we have $139,000 more life insurance. So you got 6766 more cash value, and you have 139,500 more death benefit. So from my perspective, that's a win for whole life all the way. And when you look at it from the angle of, all right, this $106,000 that I need, that let's just call it 100 grand of cash value, I need that for an emergency fund anyway. I need that to have an opportunity fund no matter what. And all this money that you see in this column is completely liquid the entire time. You're going to have massive liquidity of this money that you can utilize for emergency, that you can utilize for opportunity if you want to use it for real estate investing or anything of that nature. It's there. And all these numbers that I'm talking about just get amplified if we just go further out. If we go to the end of this year 20, you could see we put 200,000 in. We got $276,000 at this point in time in net cash value and $557,000 of death benefit. So that's, comparatively speaking, we're talking about having, we put 200 in, we got 76,872 more cash value, right? And we have $357,000, 276 of more death benefit at year 20 than we would have in the term policy. Now, do you need that? You may or may not need this insurance. I'll give you that. But I'm going to tell you, if you're looking at life insurance as just a need-based product, I'm telling you, you're looking at it the wrong way. But now with that said, so now what I want to do is I want to look not just at the cash value, not just at the death benefit, because at 61 years old, you know, there's a chance that you will, if you do everything that you want, there's a chance you will need you will be self-insured. You will have the rest of your finances in order. I would argue that the cash value sitting in this policy is going to be a better leverage tool than any other asset that you have, and it will make your other assets better. You could utilize it for real estate and all those different things. But more importantly, I think when you hit 61 years old, even if you don't want the life insurance from this, you're going to want it for other reasons. And those other reasons are the living benefits. And now let's just talk about these living benefits for a minute, because now this is the full illustration that I was showing you before. You could see all these numbers are what they are. We're way ahead at this point in time, but this is where it gets magical. I'm going to go down here to the living benefits, and you can see here, accelerated death benefit plus performance rider. So if you have chronic illnesses, you have access to this money. So let's think about this. When you're 61, there's a chance, obviously 61 and beyond, that's when you have the highest likelihood of getting sick, highest likelihood of cancer, any kind of terminal diagnosis, anything of this nature. You can see there's terminal illness policy values. We call this accelerated benefit riders or living benefits inside of the policies, right? So you have chronic and terminal riders on here. And when you're, you know, in your retirement years, these are legitimate concerns for you that you have to think about, that you have to be considering about what your needs really are. And so if you get a terminal diagnosis, if you want, and listen, this is a true near and dear conversation to my heart because of the fact that we utilize this for my father-in-law when he was diagnosed with pancreatic cancer. Having access to this capital when you have a terminal diagnosis to be able to manage your medical treatment and not just have to follow the traditional insurance system about chemo, radiation, things like that, which when you have pancreatic cancer or something like that, those are the things that actually kill you, not the cancer itself typically. You got $458,000 to use as you see fit, right? When you're talking about having a chronic, you got $422,000 that this can be made in $106,000 payments to you. This, at the end of the day, these numbers get bigger and bigger and bigger. It's not about just the life insurance. It's about the living benefits that come from this. You can see here, you could get if you have a chronic diagnosis when you're 75, you could get $614,000 tax-free from this, $643,000 for a terminal diagnosis. And so these are the things that, you know, if you need long-term care, if you become disabled for any reason, if you have anything of that nature that happens to you, these are the types of protections that you're going to need. And it's not just about the life insurance. It's not just about, when you look at term insurance versus whole life insurance, I just showed you, and I'm gonna pull it up again, right? Because I just showed you that not only are you gonna have more insurance, not only is your cash value gonna be more efficient on the whole life side right here, not only is that gonna be much more efficient than a bank account will be during that point of time, which you've got to compare it to a bank account, not an investment, because this has the guarantees that your bank account's going to have. Not only is that going to be the case, but you're going to have more life insurance, which even if you don't need it, you're going to want it. It's going to make all your other investments and assets better, and it's going to allow you to leave more money tax-free to your heirs, and it's going to create a much better legacy and inheritance play for you, which I think is absolutely a biblical thing if we want to go there, Dave Ramsey, to look at that. It's not just what you need to do, it's what you want to do, and I believe it's our responsibility to do everything we can to leave the next generation better off than what we have right now. And, you know, and I would also say that it's not just about the money. It's talking about building a system and teaching them what they can do with this money and how to leverage it, and teaching them how to be more financially, better financial stewards as they go, right? And that's a big part of it. So it's not just about the death benefit, where you see the death benefit is far less over here, and it gets much more expensive right there compared to the whole life policy, and you're paying a lot for much less over there, whereas the whole life, it just keeps getting better and better. But now you look at the living benefits, and there are no living benefits. There are none on the term. But over here, I'm going to put a big star, because the whole life insurance, you have living benefits until you die. Now, if you need long-term care, if you have disability, disability, if you have any need for this, you have access to your death benefit through the form of living benefits and accelerating the death benefit on a tax-free basis whenever you need. And to me, this is why I say a properly designed whole life insurance policy will help you at every stage of your life. When you're young, you need to save money. You need the life insurance. You probably want the life insurance for your family. It's never going to be cheaper than it is today. So to get started, get the life insurance locked in, guarantee that it's going to be there for life, because you don't know what the future holds. So having that in place is going to be important. Having the savings mechanism inside of the policy, utilizing this as a savings alternative instead of a bank. There's so many, I've done so many videos showing how you can leverage this and the power of that. It's extremely powerful. Do not compare it to an investment account, because it doesn't have the same risk profile as an investment account. So you cannot compare those things in the same way, right? So you look at that, and then you look at the living benefits, and you look at just the fact that, yes, in this situation, you need to have the $10,000. That's just the example I made. I could shrink that number. I could make it all different. But I promise you, if you do it the right way, the whole life insurance policy is always going to make sense, because as you go through and you need to save, and you go through and you need the insurance, you start a family, you're probably going to want more insurance for a period of time. But then when you hit your retirement years, even if you have your IRA and you have other assets, more bankruptcies are caused because of medical debt than any other debt. So imagine that you had your life insurance, that you could accelerate the death benefit, even if if you follow Dave Ramsey's plan and you're perfectly self-insured. How do you insulate your assets, your financial investments that you had, that you worked 40 years to save up? By keeping your whole life insurance policy in place and having the living benefits there as a backstop to make sure that those are insulated. That's how. So if you have any questions, comment in the comment section below. Any comments, go ahead and comment as well. If you are looking for a review, you want to have a conversation with anybody, I have a link in the description below. You can go down there, set up a clarity call. Our team can walk you through it. Whether you want term insurance, cheap term, convertible term, whole life insurance, anything across the board, we can help you in every way possible. Hopefully this makes sense. If you think somebody would find value in this, please share it out, like the video, share the video, all that stuff. Till next time, have a blessed, inspirational day. I look forward to talking to you soon. Take care.